Hello and welcome to Raising Capital 101. I'm Tom Voekler and I'm joined today by my special guest Mike Beville from Beville Properties and my colleagues Rhys James and John Watson. And we're going to introduce the idea of capital raising and the pitfalls and benefits and discuss why people would want to potentially raise capital. Why don't we start with some of the pros we think on raising capital? Mike, you have any ideas on?
Yeah, I think that the biggest one, most obvious, is it's almost like leverage. You're using other people's money to acquire assets, grow a business, whatever it may be, which may come at a cost. It may come at a cost up front, may come at a cost on the back end, whatever it may be, but you're able to then leverage that money to grow and do things that you otherwise would not be able to do. So I think it can open doors. It can expand what you're able to do with your company. Of course, we deal primarily with real estate and, of course, other companies. But with real estate, the easiest example is being able to go buy a larger asset maybe than you were otherwise thinking. And the returns may be better. The scale of the returns may be better. So I think it can open more doors for you.
Yeah, that's an interesting concept. I hadn't really thought about diversification. So it allows you to do something you didn't anticipate doing or couldn't do on your own, right? So opens the pocketbook up to not necessarily, I mean, if you're an entrepreneur, John, I guess, you've got an idea, but you don't have money.
Yeah, and even if you do have money, you might not want to put your personal assets at risk. At least not completely, maybe a little bit, and you can also raise capital as well. But if it's risky, you don't want to put all your money into it.
Rhys, what do you think?
John's right. That it's risk reward is a large portion of the decision to raise capital. If you're an entrepreneur, you're balancing the need for capital, the desire or lack thereof to include all of your personal assets into a single business versus the dilution of your interest in your baby, your idea, that inevitably occurs if you raise capital from third parties. So when you make that decision, that's when you've decided to engage in the capital raising process.
So he's getting into a little bit of the pro-con concept, like there's always benefits but there's risks. And what Rhys was addressing was the risk of control, losing control. So again, go to an entrepreneur, John, as we were talking about, you have an idea, you control that idea until you raise capital.
Right. And then if you sell equity in your business, then you're giving up some amount of control to your investors who will want a return on their investment. And if they don't get that return, they might try to exercise more control over your business, which could hurt, your returns as well.
So Mike, you kind of talked about now you can get into bigger assets. Does that mean you can get in bigger trouble?
Yeah, I think bigger trouble. And it's funny, we're talking about control as kind of the extreme, but man, there's a lot of scale in between there too. I mean, just having to report to somebody else. Sometimes entrepreneurs who want not just control, but they don't want to have to tell people what's going on and have people scrutinize, ask questions. And people give you their money, the first thing they're going to want is a lot more information, and they are going to scrutinize. And honestly, rightfully so. It's a big relationship that you've now entered into with somebody, and you're responsible for managing their money, so to speak. So I think that's something that commonly folks who go out and raise money come back and say, man, do I really have to talk to this person or that person? Do I really have to provide this? And sometimes you get out of the legal realm and more into just the facts of business, and the answer is typically yes.
Yeah, and you were kind of alluding to something that's always on my con list when I first talk to potential fundraisers is you have to understand this is going to occupy some or a lot of your time. So go to the entrepreneurial, idea that we were talking about. That person no longer can solely focus on whatever that idea was, or go back to real estate focus if we're talking about managing real estate or acquiring real estate. Well, now you have to spend time not only raising the capital and talking to potential investors, but you have an ongoing, if you want to continue a relationship and a successful relationship, we'll talk about it in further podcasts, what your obligations actually are, but you have an obligation of communication. And so a lot of times people don't realize that what they are great at on a day in and day out basis, they are being pulled away from to deal with capital raising.
Yeah, no, I think it's a great point. pull back to my analogy of relationships. And Rhys, I know that you've talked to a lot of people about that and the trials and tribulations of dealing with people who are demanding your time.
Absolutely. And it's not just time. As you grow, and in particularly if you are on the side of a business that is going to raise capital or intends to raise capital serially, it becomes not just a time commitment, but a financial commitment as well, as you have to dedicate resources to reporting on folks' investments, perhaps even hiring dedicated investor relations staff. And so you're going to have both time and material expenses that you don't have if you don't raise capital.
I guess going back to some of the pros, we had talked about the ability to do things that you maybe would not be able to do on your own. You may not be able to get a lender involved due to creditworthiness or if the asset is ready to be funded. So there is the ease of capital from that perspective. We're talking about control. Those controls would be different than what a lender is looking for, which may be very rigid. The payments to a lender may be very rigid. You may be able to work something out that's more on a success-based with investors. And so the actual cost of capital may be less. If you add all the things we've been talking about, between pros and cons, you have to make that analysis of what is that cost. It's not just dollars and cents, it's time. But what do you think the differences, Mike, are if you need a little bit of capital versus a lot of capital?
Well, the most important thing would be then also how many people are you raising capital from, I think, and the character of the capital that you're raising. Obviously, the more money you're raising, the more liability you could be potentially facing from different facets, which, we hope to get into more in future podcasts. But in a general sense, you take in more money, you take in more investors, you take in investors that are truly passive, maybe take in ones that are more active. I think it becomes much more of a disclosure issue, becomes much more of a access issue for investors. And again, not to keep repeating it, but how much as an entrepreneur, as a real estate developer, sponsor, how much do you want to get into that, and how much of that is worth it to you? Because it's cost, it's the time, it's everything under the sun that you'll have to now start paying attention to.
Well, I guess that ties right into some of the things we talked about with control, losing control, or having less control of your idea, your project, whatever it is. If you're looking for a larger amount of money, you're going to be going either to a larger, sophisticated investor who's going to ask for a lot more control, oversight, communication, versus more diverse, a large pool of investors that are each putting in a smaller amount, but at the end, larger than if you just go to your dad and say, hey, I need some money. So I guess from that perspective, it ties back to some of the cons. John, you have any ideas on if it's like shorter term that you need this money or like a longer term investment? Does that play at all, you think, in kind of the capital raising?
That might determine what the type of capital you want to raise, debt or equity. A short-term need might be satisfied by debt if your cash flows can cover the interest and the lender is willing to lend to you. Long-term, if you have an equity investment, then you don't have to pay it back. You can use that capital for longer projects.
That's a great idea. And I guess we keep coming back to why would you want to raise capital? And I think we covered that pretty well on here. I think we talked about it could be a less regulated as far as like banks, credit requirements, things like that. Quite frankly, it may be quicker depending on who you know, what you're raising it for, the excitement behind it. It may be a quicker way to get some capital into a project. And it may be the only way for you to be able to undertake something that you don't have the wherewithal to do on your own or to grow. So I think everybody needs to kind of think about those pros and cons. And we will go into kind of greater detail on some of the liabilities. We'll be going into how you raise funds, how you can do it successfully, a little bit about the cost of some of these things in future ones on why you'd raise capital.
One idea that I had is that the process of raising capital, you'll be scrutinized by either the lender or the equity investor. So you have to take a hard look, and they'll be taking a hard look at your business model. So if there are weaknesses in your business model, they might tend to expose that and allow you to refocus on your core business.
It lets you really line up what you're doing.
Exactly.
That's a good, I guess, getting you ready for potentially a larger market, getting you ready for growth. If you have a successful product, I think we've all been there with a client that has grown over time. And, John has a good point. The requirements of those larger investors become more and more strict. And so if you get into good governance early on and good business plans and good communication, it could be a very good way of being ready to ramp up. Rhys, any last words of wisdom?
I think that, as they were saying, you go through a little bit of expense up front on getting your house in order, and you'll prepare yourself for avoiding a lot of expense down the line relative to your growth plan. And as we get into more of the legal side of things, I think the point here is that as an entrepreneur, as a real estate sponsor or developer, it is important to weigh the business cost of capital, which, as we've discussed, is not just the 8% you're paying on the loan or the 20% of the company you're giving up in dilution, but also the time and expense related to dealing with that investor or dealing with that bank, or the dilution of your control of the business, having to listen to another voice speak to your idea, which may be a benefit, but a lot of folks sometimes don't see it that way initially. Weighing all those things versus what do you need that capital to do? What are you growing into? What are you diversifying into and from? How are you, as Mike said very early on, leveraging your idea and your capital, using the capital of third parties in order to really further your business aims? So it's a decision on the business front before you get into some of the more legal minutia that we'll start pointing towards.
That'll wrap up today's discussion on some of the aspects of raising capital. Thank you, Mike, for joining us today. If you have any questions or suggestions for future episodes, please contact me. You can also visit our securities and corporate governance and REITs web pages at williamsmullen.com. There you can find out more about our team as well as legal alerts. And finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening. Until next time.